Right now, almost half of all investors in America are too scared to put money in the market, which means if you're watching this, this might be the best time to start that you're ever going to get. Here's why. April 2nd, 2025, a Wednesday. President Trump walked into the White House Rose Garden and announced sweeping tariffs on nearly every country on Earth. He called it Liberation Day. The markets called it something else entirely. The S&P 500 dropped over 12% in a week. The Dow lost 1,700 points in a single day. Trillions with a T evaporated from market value in 72 hours. JP Morgan warned of a global recession. Bill Ackman went on the internet and said business investment would grind to a halt. People panicked, logged into their brokerage accounts for the first time in years, sold, watched the numbers turn red, sold more. And then, quietly, without much fanfare, the market recovered. And then hit new highs. That was a year ago. Right now, heading into April 2026, nearly 50% of individual investors surveyed by the American Association of Individual Investors are bearish. Half the room. Scared, waiting, sitting on the sidelines with cash they don't know what to do with. 50% of the room is scared. That's your invitation. There is a concept in investing that sounds simple and is almost impossible to actually do. Buying when there's blood in the streets. The idea is that the best time to invest is when everyone else is too scared to. When headlines are bad, when your coworker is telling you to wait, when your gut says this feels deeply, specifically wrong. Warren Buffett said, "Be greedy when others are fearful." Great advice. Approximately nobody follows it because fear is a physical sensation and a spreadsheet is not. And I already know what you're thinking right now. You're thinking, yeah, but this time actually is different. The tariffs are real. The uncertainty is real. This isn't regular scary, this is a different kind of scary. I hear you. It always feels different. That's the whole point. If it felt the same as every other dip, everyone would just buy and we wouldn't be having this conversation. The AAII Sentiment Survey, been tracking investor mood since 1987, has had bearish readings above 49% for 3 consecutive weeks heading into April 2026. Historically, when bearish sentiment is this elevated and this sustained, the market delivers above average returns over the following 6 to 12 months. Not always, but consistently enough that professional investors pay very close attention. Because sentiment is a contrarian indicator. When everyone's already scared, the selling has usually already happened. Bad news is priced in. What's left is the recovery, not a prediction. Anyone giving you predictions is selling something, usually a newsletter, usually $49 a month, usually written by someone whose only proven skill is selling newsletters. And whether you think Liberation Day tariffs were the right call or the wrong one, smart people genuinely disagree on that. The market's reaction and its recovery were the same either way. But the combination of elevated fear, a market at a discount, and the historical behavior after Liberation Day style shocks paints a specific picture. The people who invested a year ago when everything looks terrible made money. The people who waited are still waiting, still watching, still looking for a sign from the universe that has never once in the entire history of financial markets actually arrived. Real numbers, fast. I know you didn't open YouTube to read an economics report. And honestly, neither did I when I was putting this together. The US stock market is currently trading at roughly a 12% discount to intrinsic valuations, which means the market is cheaper than what the underlying companies are actually worth. Large caps at a 13% discount, small caps at 17%. You are being offered a sale and standing outside the store complaining about the weather. The economy is not in recession. GDP grew 2.8% annualized in Q4 2025. Consumer spending is still happening even though consumers are nervous, which describes every American in every year since approximately 1987, so not exactly breaking news. Corporate earnings have grown for 9 consecutive quarters. The Magnificent Seven, the 7 tech stocks that carried the entire market on their back for 2 years, are finally correcting, which finance media is reporting as catastrophe. It's not catastrophe. It's money rotating out of 7 stocks that were up 400% and into things that actually make physical objects. Wild concept. The market is broadening out. That's not a crisis. That's a normal Tuesday in a healthy economy. The Fed is expected to cut rates 2 to 3 more times through 2026. Cheaper borrowing, more corporate investment, earnings expand. It's not complicated, it's just slow. And if something doesn't have a chart that goes vertical in 6 months, finance Twitter doesn't want to hear about it. The fear in the room is significantly larger than the reality on the ground. That gap, right there, is the whole point. Let me tell you about someone you probably know. He's been meaning to start investing since 2020. Had the tab open, Fidelity homepage, sat there for 3 days. Then the pandemic got worse and the market dropped and he thought, okay, I'll wait for this to settle. Then it settled and he thought, okay, but now it's too high. Then 2022 came and it dropped again and he thought, okay, see, I was right to wait. Then 2023, it came back. Then 2024. Then Liberation Day. Now it's 2026 and the tab is still open. Different browser, same tab. He didn't lose money, he just never made any. And in 5 years, he'll tell you he's waiting for the right time. That guy is not an idiot. That guy is most people. That guy might be you. I'm saying it with love, not judgment, but I'm saying it. And the only difference between that guy and someone who actually builds wealth is not intelligence, not income, not timing. It's just the decision to stop waiting for a feeling that was never going to come. You have $10,000 you want to invest. You're going to wait. For what exactly, you're not sure. For the news to calm down. For things to feel safer. For some signal. Here's what waiting actually costs you. The average annual return of the S&P 500 over the last 30 years, crashes, recessions, tariff wars, pandemics, all of it included, is roughly 10% to 11% per year. At 10%, $10,000 becomes roughly $67,000 in 20 years. You wait 2 years instead, just 2. $10,000 invested 2 years later grows to $55,000 over 18 years instead of $67,000. You didn't lose $12,000. You lost $12,000 in growth on $10,000 because you waited for a feeling. You're not waiting for the right time. You're paying a daily fee called inflation to not make a decision. And here's what gets me every time. Everyone knows the market will be higher in 20 years than today. Everyone. Retail investors, professional fund managers, your uncle who lost everything in 2008 and still somehow knows this. It is the single most agreed upon thing in all of finance. And yet, most people are standing outside the building waiting for the smoke to clear before they walk in. The smoke doesn't clear. There is always smoke. The people already inside weren't brave or smart or well-connected. They just stopped waiting for conditions that were never going to arrive. The market doesn't wait for you to feel comfortable. Comfort is the most expensive luxury in investing. This is the part where I'm about to sound like every other finance channel on YouTube. Emergency fund, 401k, Roth IRA, index funds. I can feel you reaching for the back button. Don't. Because here's the thing about simple. Simple doesn't feel powerful. And that's exactly why most people stay broke. Not because they couldn't find something complex enough, because they dismissed the simple thing and spent 6 years looking for an edge that doesn't exist. Starting from zero, April 2026. First, before a single dollar goes into the market, 3 to 6 months of living expenses in a savings account. Not invested, sitting there, boring, liquid. Because if the market drops 30% and you also just lost your job, you do not want to be the person forced to sell everything at the worst possible moment because rent is due Friday. The emergency fund is not optional. It is the floor. And yes, I know you've heard this before. The fact that you've heard it and still don't have one is a separate conversation we don't have time for today. After that, if your employer offers a 401k with any match at all, contribute enough to get the full match. A 100% match on 3% of your salary is a 100% guaranteed instant return. Nothing in any market anywhere beats a 100% return on day one. That's not investing, that's arithmetic. Then, Roth IRA. In 2026, you can contribute up to $7,000 a year. Goes in after tax, grows completely tax-free, you pay zero on the gains in retirement. Zero. And I'll be honest, it genuinely irritates me that this exists, and most people under 40 have never opened one. The government literally built a tax-free wealth machine, left it sitting there with a sign on it, and people are out here putting money in savings accounts earning 0.01% interest like it's 1987. Inside both accounts, you are not picking stocks. I don't care what your coworker told you about NVIDIA, you are buying one index fund. If you're on Fidelity, search FZROX. Zero expense ratio, zero minimum. Total US market, one purchase. You now have a better investment portfolio than most Americans, and it took you less time than deciding what to watch on Netflix tonight. Set it up. Automate a monthly contribution. Do not look at it every day. Do not sell when it drops. Keep buying. That's it. The market is not your biggest risk. Inflation is not your biggest risk. Tariffs are not your biggest risk. You are. The average individual investor significantly underperforms the market over time, not because they pick bad stocks, because they panic sell at the bottom, buy back in near the top, try to time things, get scared, get greedy, get bored, and generally manage to do the exact opposite of what they should at every single critical moment. It's almost impressive in its consistency. There was a study, I think about this more than I probably should. Fidelity looked at their best performing accounts over a long stretch. The accounts with the best returns belonged to people who had either forgotten the account existed or had died. We built the exchanges, the ETFs, the robo-advisors, the CNBC anchors in their very serious suits, entire universities with finance departments, a $100 trillion global capital market, and the data says the winning move is to put money in and then forget you're a person who makes decisions. All of that infrastructure, all of that complexity, and the answer was just, don't touch it. And look, I'm not going to pretend I've never checked my account on a bad market day and felt my stomach drop. I have. Everyone has. The difference is what you do next. The version of you that logs in when the market drops 8% and starts generating very creative reasons to sell, that version loses. Every time. Your brain evolved to avoid saber-toothed tigers, not to hold index funds through a correction. It is genuinely not built for this, which is why you automate, set it, forget it, and treat your investment account like a message you sent that you cannot unsend. The market rewards patience and punishes activity. Counterintuitive, stubborn, non-negotiable. The fear right now is real. I'm not going to tell you everything is fine, because everything is not fine. The headlines are genuinely noisy. The uncertainty is real. And yes, but uncertainty has always been real. It was real in 2009 when the financial system nearly collapsed, and people who bought the S&P 500 at the bottom made 10 times their money over the next decade. It was real in March 2020 when a pandemic shut down the global economy and the market recovered in 8 months. It was real exactly 1 year ago on Liberation Day, biggest single-week drop since COVID, and then the market came back. The people who waited for certainty, for the smoke to clear, for the feeling to arrive, for the right moment, missed every single one of those recoveries. Every single one. There's a guy right now with a Fidelity tab open. Has been for 6 months, maybe a year, waiting. And every day he waits, he's paying a daily fee called inflation and missed compounding to not make a decision that takes 11 minutes. Don't be that guy. The best time to invest never feels safe. That's not a bug in the system. That's the whole design. Safe feeling and good returns have never lived at the same address, and they're not about to start in 2026. Everyone's scared to invest in 2026. That's exactly why you should. If this video made you uncomfortable enough to finally open that account, subscribe. If you watch the whole thing and you're still not convinced, dislike it. Genuinely, I mean it. I'd rather have honest feedback than a pity follow from someone who's still going to have that tab open in 2031, wondering why their savings account didn't make them rich. Subscribe if you want. Don't if you won't. The index fund doesn't care either way, and honestly, neither do I. But the algorithm does, and the algorithm is the one thing in 2026 that's harder to predict than the market. So do with that what you will. This is Breaking Money. See you in the next one.